Welcome to today's deep dive. We've got a really fascinating stack of your sources today focused on decoding the hidden costs of Forex trading.
Yeah, this is a really crucial topic to unpack.
Right, because our mission today is figuring out the exact difference between the spread and commission pricing models.
And, why a trade that looks like a total winner on your chart can actually lose you money once the real costs kick in.
It's crazy. It's like, when you buy concert tickets and you face that classic dilemma.
Oh, yeah, the absolute worst.
Right. Like, do you want the convenience of one baked-in price up front, or do you want the raw ticket price, knowing a completely separate service fee is just, like, waiting at checkout?
That is a perfect analogy.
Yeah.
And whether you are opening your very first account or stepping up to test automated trading algorithms, understanding that exact distinction is the secret to knowing how efficiently you can actually enter and exit the market.
So let's start with that baked-in ticket price, the spread-only model. Based on the research you send over, this is the default for a lot of traders, but I mean, what's actually happening behind the scenes there?
Well, the spread is simply the gap between the buy price and the sell price. Let's use the Euro USD example from your notes.
Okay, sure.
So the toll is 1.1000 to sell and 1.1002 to buy. That difference is 2 pips.
And a pip is just the standard unit of price movement in Forex, right?
Exactly. But because you always buy at the higher price and sell at the lower one, your trade instantly starts in the negative.
So you're instantly in the red the second you click.
Yep, you start out behind.
But honestly, I get why people like this model. It feels clean, you open a trade, and there's no extra line item for a fee just staring you in the face.
Right, it's psychologically easier to deal with.
But is that illusion of simplicity actually a trap? Like, are we losing our edge just for a cleaner interface?
Well, it depends. It's only really a trap if you're holding on to trades for minutes instead of days.
Oh, really? Why is that?
Because if you are a swing trader keeping a position open all week, paying a 2-pip spread barely dents your profit. It's just noise.
Right, because you're aiming for much bigger price swings.
Exactly. But if you're a rapid-fire trader making dozens of trades a day, those tiny gaps compound quickly and, they eat your margins.
Ouch. So if I'm one of those rapid-fire traders bleeding out from 2-pip spreads, how do I bypass that baked-in cost? Is there like a wholesale option, or is the broker just shifting the math around to trick me?
You go for the wholesale option, which is the commission model.
Okay, how does that work?
This strips out that built-in cost, giving you the raw core market price. So sometimes the spread is near zero.
Wait, zero? That sounds too good to be true.
Well, yeah, in exchange, the broker charges a flat, transparent fee for every block of currency or lot that you trade.
Ah, so this is why your sources say algorithmic strategies and expert advisors flock to this setup. I mean, their software trying to grab tiny profits constantly.
Right, exactly. Shaving off even half a pip changes their entire profit model.
Makes total sense.
It does, but here is the catch. A zero spread doesn't actually mean a zero cost.
Right, the broker still has to make money somehow.
Exactly. You always have to calculate the all-in cost. That's the raw spread plus the fixed commission fee. Experienced traders don't even look at the headline spread. They calculate the effective costs of a full round trip.
But let's take these clean theories and drop them into the chaotic reality of live markets. Is one definitively cheaper than the other?
No, because spreads aren't static. They breathe.
They breathe. What do you mean by that?
When major economic news breaks or, during the daily rollover, when global trading sessions transition, market liquidity just dries up.
Oh, because the big players pull out?
Right. The big banks and liquidity providers pull back to avoid risk. And when they step back, the gap between buyers and sellers naturally widens out.
Wow. Okay, so it's like if the service fee on your concert ticket suddenly tripled in the 10 seconds you spent typing in your credit card number.
Yes, that is exactly what it's like.
That means falling for marketing buzzwords like zero spread is a huge risk.
Yeah.
If a broker's platform freezes up during that volatility or their execution speed drops, that cheap account is completely useless because you can't get your trade filled when it actually matters.
Which is why platform stability and structure matter just as much as the pricing. It is the reason you see traders migrating to platforms that offer multi-account flexibility.
Like what? What platforms do that?
Systems like MT4, MT5, CTrader, or broader broker ecosystems like Monaxa. These are valuable because they let you open different account types under one roof.
Oh, that's smart. So you can mix and match.
Exactly. You can use a spread account for your long-term trades and a commission account for your algorithms, matching the tool to the specific strategy.
So for you listening, the takeaway here isn't to just blindly chase the lowest advertised number. It's about matching your pricing model to how often you trade and how long you hold.
Yeah, choose the structure that gives your specific strategy the clarity it needs to function.
Totally. Well, before we wrap up, I want to leave you with a thought from all this. If spreads can widen drastically the exact moment major news breaks, how much of your trading strategy is actually capitalizing on market movement, and how much is just fighting the hidden mechanics of your broker's pricing model?
That is the real question to ask yourself.
Next time you're choosing between the baked-in price and the raw fee, make sure you know exactly what game you're paying to play.